I think the first thing I want to start with is why distribution matters. And this image here is a picture of closed pumps, closed petrol pumps, more importantly. And this for me epitomizes the importance of distribution. We lived through this petrol crisis a few weeks ago, and it wasn't petrol that was the problem, it was the lack of HGV drivers to get it around the country. So the point is that you could have a fantastic product, but if you can't get it to the forecourts and in front of customers, it is absolutely useless. And that analogy applies to investments. There are some brilliant boutiques out there and fund managers, but they overestimate the importance of the art of managing money, and they completely underestimate the importance of getting it in front of the client. Managing money is just one part of that value chain. And equally in other parts of the investment world, sales and marketing can keep money coming in long after performance has weakened. So I would argue that performance, brand, marketing, and distribution are all equally important factors. I'm going to start first of all by looking at why Europe is so important, and I'm assuming that most of you are focused on Europe. So European fund industry is large and dynamic at 10.7 trillion euros at the end of October. IFAMA, the European Fund Asset Management Association, will tell you that it's twice as much as that, but that's because there's a lot of double counting in their numbers. So UCITS legislation and more latterly eighth and MiFID legislation has provided a robust framework for cross-border fund distribution. And Lux and Dublin in particular have become major host centres for cross-border fund ranges. And because the UCITS brand is trusted, those funds are also authorised and distributed in Asian markets such as Hong Kong. So as a result of that cross-border trend, the market, cross-border funds or cross-border distribution represents 52% now of European industry assets at 5.6 trillion. So, roughly, so that's 52%, up from about 35% 10 years ago. So, constantly growing. So apart from the cross-border market, the largest domestic markets in the UK, in Europe is the UK with 1.6 trillion euros in assets. And you may be surprised to see that Switzerland is comparatively small. That's because most of its fund managers are cross-border, so they will be part of that whole cross-border market that is distributing through Luxembourg and Dublin. So in terms of net flow, we're also seeing a significant amount of business happening. Cross-border business for the year to October accounted for 3/4 of the 585 billion that was registered this year alone. So that's a huge amount of business. That's the size of a small market. That's pretty substantial. And of that 585 billion that's being registered every year, or this year for sure, the UK is the largest domestic market with 39 billion of net flow. So around 7 to 10% roughly. And Germany is the second largest with another 4%. So one of the reasons that Germany and the UK probably stand out a little bit from the crowd is because advice plays a slightly bigger role in that market. In this chart here, I've charted which channels are held in the different European markets. And I think the first one that stands out immediately is the UK with very much an advice-led distribution model in marked contrast to other European markets. So private banking and wealth is much more important in Switzerland, of course. And as you can see from the German bars, advice plays a bigger role than in other domestic markets. But if you look at France, Italy, and Spain, they are very much bank-dominated distribution models. So I think I just want to quickly explore why the UK is different from Europe. And I suppose the main difference is that the UK has a long tradition of stockbroking, and it has always been much more pro-equity than other more conservative markets in Europe. Wealth management in Europe has tended to be for the very rich, with a private bank culture rather than a sort of more mainstream. We have a more of a wealth management in the UK starts at sort of mass affluent and upwards, whereas in Europe, that tends to be the preserve of banks before it gets up into the sort of high net worth area. The other big difference for the UK is pension provision. We've got a very poor state pension, so we have to look after ourselves. Defined benefit pension schemes have all but disappeared. So this creates an urgency for us to save for retirement. Last but not least, in 2015, the government introduced pension freedoms, which basically allows us to unlock our pension pots and decide how they're managed, so we can move them around and put them onto investment platforms, etc. And what that's created is a much longer glide path. So whereas before everyone would accumulate money until 65, 70, then retire and take that money through an annuity, now that money stays in the investment world and carries on being invested until death and even beyond, because people want to leave that money to their families. So this has shifted the UK from what was essentially an accumulation industry into a decumulation industry and managing that money. And so that's really given the UK a significant boost. The last point I want to make is also about just generally tax incentivized products and wrappers. So we have a whole array of ISAs and different schemes to encourage investors to save and invest. So coming back to Europe and the distribution trends, because this is really what we want to talk about today. I think the main thing really that you should be aware of is that regulation and technology have driven a huge amount of change in how investments are distributed in Europe. That change, that regulation is MiFID II, is UCITS, is ACE, is a whole array of different types of regulation that gives us a robust framework, but has also created and had an impact on fees and the way clients are charged. That has in turn driven a consolidation because it is expensive to operate in this business. So that has driven a consolidation in the number of platforms that are distributing those products. So we've now gone from what, a few years ago were about 30 to 7 to now 3 global platforms, which are MFEX, Clearstream, and Allfunds. Okay. Now, regulation also makes it much more expensive to do business in Europe, and that's resulted also in fee compression, cost expansion, and of course, an increase in complexity. And that means that for fund managers working with these large multinational platforms, you need to have scale, breadth, and depth. And that, of course, favors the very large fund managers. And concentration, the concentration of assets is therefore an ever-growing problem. So that means essentially that this, European distribution becomes a big scale game. Can you afford to compete with the much larger fund managers is the question that boutiques are often asking themselves. Investment trends are also another big factor. In the UK, 45% of all UK platform business is now generated through model portfolios. Why does this matter? Because the UK is always a few years ahead of Europe. So what is happening now will start to happen across Europe over the next few years. And it has already started. When I was at Fund Forum in Monaco last month, L&G, Legal & General Asset Management came onto my panel and were describing how they were traveling all over Europe and selling their investment solutions to all sorts of providers, from life companies right through to private, to family offices and private banks. So there is already a growing demand. So based on that, the fund managers really need to consider what kind of product they're selling or distributing in Europe. Are you part of the component, or are you the parcel? Are you providing that whole investment solution? Are you providing that asset allocation complete solution to the different providers? The other factors that you really need to bear in mind, of course, are the growth in passive investments. So you are going to be competing on a fee basis as well. So the growth in passive, and of course the growth in ESG products. Now, ESG takes a little bit of pressure off passive because we can't do it completely. We can't do passive in a completely ESG way, but it is rising. Passive is a big factor of the global European distribution. MFEX on my panel in Monaco again also said that 30% of all fund flows through MFEX platform are passive funds. So that has major implications again for fund managers. So before you all go off and cut your throats, there is a way to stand out from the crowd in this world, and I think, you know, as anything, when you have huge platforms, standardization, when the world has turned into what looks like, you know, generic high streets on every corner, the same brands, the same big brands, the same blockbuster funds, that also creates an opportunity to disrupt, to, you know, for boutiques and different strategies to grow. Yeah. I think the first thing to be aware of in this environment is you need to have a global outlook. And by global, what I mean, you know, when I talk about globalization, I'm really talking about doing more with less. So that means global investment teams, but making sure that you have a local presence in terms of salespeople. Far too many times I get phone calls from fund managers, you know, US fund managers who ring me and say, wait, we fly in every 3 months and we still don't understand why we're not getting any sales figures. We're not getting any sales. Well, that's because that's just not enough. You need to have a local presence. You need to reassure your distributors that you're here to stay. I think the other way to stand out from the crowd really is through co-creation. By co-creation, I mean sharing a product or thought leadership with your distributors. So rather than waiting until, passively waiting, I would say, until your distributors or potential distributors are putting together products, work proactively with them, start designing, work with them to design those products, work closely with the distributor to develop a product, a vision, an idea. And sometimes that co-creation can work in two ways. They may know exactly what they want and they're very clear about it, and they just want you to execute, and they just want to control the value chain and keep costs down. And that's fine. And you can do that bit because you're going to get that guaranteed money. But other times they're really looking to create solutions with you. And thematic funds are a really good, you know, a case in point. So, you know, if they're looking to, you know, to create jointly branded solutions or a thematic range or something, fees in that regard will matter less. They're more interested in the actual solution and in providing the right outcomes for the end customer. Okay, and so they, in that situation, again, they might want to create sleeves of products, and they're looking across those different areas. I think the main thing really is, if you are a boutique, to stand for something, and that's really important because I've come across far too many boutiques who try to be all things to all people, and it's impossible to do that. So stick to your knitting, stand for something, be the best in class, and promote your niche area constantly through content and thought leadership. If you are a blinding European asset manager, it's already a very competitive market, but by constantly promoting that content and thought leadership, then, you know, your message will get across. Okay. I think the other real really important thing here is culture. Remember your focus, your value proposition, and your purpose. Again, you cannot compete across all channels with the large managers, but you can compete by differentiating in specific channels. So find your niche, find the product that's going to work through a particular channel and focus on that and build that through, okay? And I think the last one on this page that I think it's really important to focus on is reporting. All too many times, investment funds, investment boutiques let themselves down because they haven't given any thought to the pipework, the infrastructure. If your funds are going to be on these different platforms, these three large platforms like Allfunds, MFEX, and Clearstream, then you need to have the necessary infrastructure to support that. You need to be able to provide the reporting. You need to have all the links in place. And that is really, really tough. I think that's where a lot of boutiques and fund managers completely underestimate the demand and the need to do that. So I think that's a really, really big factor. I think another really important point to discuss here is the sheer number of funds in the market. There are in Europe some 40,000 funds, as we well know, and the last thing platforms want to do is load more funds. They've got more than enough, and they've got more than enough mediocre funds. So they're constantly on the search for excellent quality products. They do not want another load of what's the word? Crap. Sorry. They do not want to upload another load of funds that just don't meet anybody's performance expectations, and there's far too many of them. So I think this is the biggest problem that fund managers are going to face in Europe, is one, getting their products listed on platforms that are already overwhelmed by too much product. So you need to work so the way to do this is, again, is to work very closely with your distributors. Make sure that you're providing the solution, make sure that you're really focused on what you're doing, and make sure that that your distributors are demanding those products from those platforms, because that is how you're going to get on board. Okay. So that's how you stand out from the crowd. Does anybody want me to discuss the UK in particular? Because I have got some slides on that, if that's what you want. I'm not sure if you want me to do that or not. Should I carry on? Chat? Yes, please. Okay, good.
Yes, please. Yeah, go for it.
Good. Okay. So I've done a few slides on the growth of the UK platform industry, because I think that's really interesting. These charts are September. So you can see here the industry's grown substantially in the last 11 years. We're now at just over 800 billion and growing rapidly. And what else? And the other thing you can see here is that the biggest driver, as I mentioned earlier, is SIPs and pensions. So whereas you have the ISAs were obviously quite big, you can see the ISA is fairly steady, the ISA business, and the SIP and pension business is growing rapidly. You also have a substantial amount of general investment business, and again, that's been, when advisors have used all their different allowances up, they then start using those. So it's going down. Sorry, it's not doing what it's supposed to be doing. Here we go. Yeah. So I think this will show you here just how much business is being driven through the platforms. So this is net flows over the last 10 years, and as you can see, in the last, since 2015, when pension freedoms were introduced, SIPs and pension business is the lion's share of the flow. So that has really boosted the UK industry and will continue to boost it. If you imagine that normally invest around 20 billion would go into annuities most years, every year. That 20 billion is now coming consistently into the platform world, and that continues to generate. And as baby boomers are retiring, that business will also continue to grow rapidly. What is also really interesting is I talked earlier about model portfolios generating about 45% of all flows. What this chart does is shows you the influence in the investment world, and this is a really particularly important factor to bear in mind. We've charted here assets going up, platform assets going up under administration, and how much is being influenced. So of course you've got funds of funds, you've got preferential funds, but you also have model portfolios and centralized investment propositions. And that is the fastest growing area of the investment distribution market in the UK. Advisors, and you can ask me loads of questions at the end of this. I'll be done in a couple of minutes. More and more business is risk profiled and targeted, so risk targeted and risk profiled. Model portfolios by DFMs, by advisors, by fund managers, and by platforms are where all that business is growing. That business can be both in-house and ex-house, and we see that growing rapidly. So we expect model portfolios really to it's already at 45–50%. We think in the next 5 years it will rise to 65–70%, if not more. And I think the main thing, so we can discuss what is happening exactly. And advice trend one, obviously regulation is driving change. Consolidation. We're seeing advisor businesses consolidating because it is expensive to run an advice business. We're seeing those advice businesses taking the risk out of their businesses by using model portfolios. So very large advice firms will create their own centralized investment proposition with their own model portfolios. Smaller firms will outsource maybe to Brewin Dolphin or to Brooks Macdonald or other providers, and so on. They also have, there's also a trend for large advice firms to obtain their own discretionary permissions. There's a question there, let me have a quick look. Can we get the slides, please? Of course you can. So there is also a trend for advice firms to obtain their own discretionary permissions and run the business internally, because that way they hold on to more of the revenues. All of these trends that I'm talking about are a state of flux. We've seen white label, we've seen advisors decide to launch their own platforms. And then realize that actually they're not a platform business, they're actually an advice business, and they've landed themselves with a huge headache and a whole load of costs and stuff that they don't want. So, it's all constantly changing. There is also the rise of sub-advised funds. So if you take somebody like, or organizations like Quilter, St. James's Place, True Potential, those three advice firms between them control probably about 40% of all the advisors in this country, and they all have sub-advised funds. And the way sub-advised funds work, you don't need me to tell you this, but of course the funds are their own funds, and then they ask you, the boutiques and the fund managers, to manage those funds for them, but at a much lower price. It's a quid pro quo situation. You manage the money for us, we'll give you 25 bips, we'll keep the rest, but we're going to guarantee that you've got that money. So, it's a bird in your hand against two in the bush kind of situation. What this means really, obviously with the rise of that kind of sub-advised trend, with the rise of model portfolios, etc., is that it is a much tighter investment proposition and there are fewer funds overall. So if you are a smaller fund manager, it is much harder to find your niche and you will have to work much harder. Let's move on to. So channel trends. The pandemic's obviously really accelerated some of these trends. We've seen adoption of e-practices, accelerated pace of digitalization. So everything is now done what, a few years ago would have been impossible for platforms to accept, dry signatures. That's all happening now, very much so. I think another big trend is the surge in direct business. And you may have seen from my earlier slide that there was a big chunk of direct business in the UK, now represents about 15 to 20%. That really happened during the pandemic, because millennials had nowhere to spend their money. Basically, they had no football matches or sports events to bet on. They weren't going out, they weren't doing anything. So they were accumulating money, even though they were furloughed. And that led to an interest in investments, and that interest, although it has waned a little bit because everyone's back to work, it is still quite strong, and we expect that to grow. So we have reached a tipping point. There is an interest there, but millennials, of course, do not want to pay for anything. A bit like us, we used to pay for CDs and records and all sorts of things. My kids, they don't want to pay for a thing. And that is very much the stance. So low cost is a factor, very much a factor in how we distribute to in the future. Passive, low cost, digital, and artificial intelligence. This is advice trend number 2. I mentioned SJP, True Potential, and others. The value chain between the fund manufacturer and the end consumer has got longer and longer. And so what we're seeing really is that different parts of the value chain are securing distribution through vertical integration, or just by, moving into the next part. So that means things like, platforms like Aberdeen, Quilter, Fidelity, etc., having small or large distribution arms, or advice networks. That means wealth managers buying advisors, advisors buying wealth managers. That means fund platforms buying or launching their own investment arms, their own wealth managers, and so on. So we are really in a world that is changing rapidly. It is creating, to a certain extent, if you have large parts of the country controlled by different providers, it is creating sort of like an ecosystem, or almost like a Google and Android and Apple, etc. So it will be difficult to move from one vertically integrated organization to another. But this is how the distribution in the UK is being secured or locked in through vertical integration and by buying other bits of the value chain.
There you go. Right, so if you want to ask a question, please feel free. All right.
Hi, Bella. It's Stephen Sullivan here.
Hi, Stephen.
Hi, Stephen.
Right. Hi. I work in fund distribution in the UK. Mm-hmm. So I basically wholeheartedly agree with everything you just presented. I particularly like the slide where you reminded fund managers that their funds don't sell themselves, despite how good they might be. So any fund managers on the call, do remember that we are an important part of the chain.
I think that, it is, it is exactly that. For me, the petrol crisis was just that. We had this glorious product, black oil, oil. We couldn't get it to the forecourts, and that the whole world fell apart. So, and it is very much. I've seen a lot of arrogance over the years. I've been around for a long time, so I've seen a lot of boutiques who go, "Oh yes, my product can sell itself." No, it can't. You can manage the money, but other people have to sell it for you. So I think that's an important thing to remember.
We've had a question in, Bella, about does cost come into play in the UK?
Yes, it does come into play in the UK. So this is platforms in the UK position themselves in a number of ways. One, that they have been able to negotiate really good fees with fund managers. So if you're the likes of Aegon or Fidelity or Nucleus or Transat, then you've been able to negotiate really good fees. So yes, fees do come into play, because if you're a platform, let's take Standard Life, or as it's now called, Aberdeen, or a burden as I like to call it. So the burden wrap is a bit more expensive. And so if you look at it from an advisor's point of view, he's going to look at that platform as an overall cost to the client. He wants what he used to charge, the 1.5%, for example, now has to be his advice fee, his platform fee, the fund fee, etc. So he's not going to cut his own. He's not going to cut his own neck. He's not going to cut his own fees, but he's going to negotiate hard on the platform fee, and then he's going to want to know that the platform has negotiated hard on the fund fees. The overall cost is important, and yes, so yes, fees are important, and it is what is driving the passive revolution, if you like, in the UK, because people are looking at the likes of Vanguard. Vanguard is the top selling fund manager. And they're looking at the likes of Vanguard and realizing that, they can get a Vanguard fund on a Vanguard platform in a Vanguard pension for 60 bips. It's really hard to compete with that. So
yeah, the days of high fees with performance fees, for example, are long gone, aren't they?
Those fees are long gone, but it's also what I'd always say to fund managers is there's a lot of fat in their systems. They really need to look at, in the same way that one of the things that we're doing with Finscape is you need to do less with more. And the way to do less with more, to do more with less, I mean the other way around, is using data. So use the data insights. So, a lot of fund managers sort of take a scattergun approach, and they're sending someone traveling all around the country and just trying to sell their fund at anything that moves. That doesn't work anymore. You've got to be really clever with your data. You've got to analyze your market. You've got to choose your channel and really be focused and targeted, because that way you can do a lot more with less by using data cleverly and keeping your resources, keeping your business trim, and cutting out the fat. I think
definitely some inefficiencies at all levels. I mean, we find that as a management company, where we're dealing with administrators who are, as we said before we started, about dealing with fax machines. The straight-through processing and things like that are a fantasy right now, but we'll get there in the end, I hope. Have we got any more questions from anybody listening in? Anybody want to stand? Oh, there you go.
Typing.
Hybrid marketing. What do you mean by hybrid marketing, Kate?
Well, as Stephen said there, can you hear me? As Stephen said, sales and marketing people are an integral part of this process. And since COVID, there's been a change to the dynamics of how that happens, like this today. We're doing it all by Zoom. I'm interested in because how you have seen that trend, and you said that you were in Switzerland at a conference the other day. So obviously people still want to be face to face, and we're humans and we need that. But what is your view, covering everything that you cover, on the move to hybrid marketing, like online, in person, groups?
So I think yes. So certainly. It was quite difficult actually in Monaco, because as we moved around, we had to be masked. It was quite different from the UK. We had to be all masked up, etc. So, but there is a real, we are sociable creatures. We do want to be together. But I think we recognise that we can travel less and we can be more focused. And I think that's certainly what's happened in the UK in terms of the advisor industry. They've suddenly realised that rather than wasting their time travelling to clients' houses, they can do a lot of their demonstrations, etc., online. And the pandemic has forced that change. If that hadn't happened, people wouldn't. There are a lot of them are dinosaurs. Let's the industry is populated with a load of dinosaurs. So the pandemic has forced people to adopt new technology, and that's a good thing. And it just, what that means is that it gives us a broad array of different things. I know that, you know, when I'm organizing my meetings, my PA says to me, is this online? Is this face-to-face? You know, what do you want? And there are some meetings I'm going to go, right, this is a demonstration, so it's got to be online because it's much more suitable for online, you know, rather than me trying to sit in a room with loads of people peering around a screen. You can all sit and watch it comfortably. So hybrid marketing is definitely the way forward. And that has been, certainly in the UK, been picked up strongly across all parts of the industry. But we still want to meet face to face and have a drink. Definitely a glass of wine. Yeah.
Exactly. Thank you for that, Kate. Any other questions? We're getting up to 40 minutes. I'll take that as a no at this stage. So
I hope that was useful. Sorry, I'm
very useful. It was, yeah. I should have said at the beginning that we have recorded the session, as I've said in the chat there, that the recording will be on the website. We will send the slides through to everyone afterwards. It just leaves me to say thank you very much to Bella for her time today. If anyone's got any further questions subsequent to this, please send them through to me and I'll get them through to Bella and we can come back to you directly. But in the meantime, it leaves me to say thank you very much for everyone's time today, and we hope you enjoyed it, and we look forward to seeing you the next time. All right, all the best now.
Bye-bye. Take care.